since I graduated from high school in 1995 and made that right every day. And I went to college at Adams State College, and then I started working for H&R Block in 2001. So I've been there quite a while. I can tell the clients now I'm part of the building. I've been there, and I've worked with Marie since about 2009. And Michelle, I don't remember the exact year, but it's been about the exact same. She's Alamosa Monte Vista office. So that's just a little bit about where I'm from. And then we do all sorts of taxes there, just various things. They're generally electronically filed. The clients have ways to come in. They can come in and sit with us. They can do a virtual appointment now just with the computer. They can email, text. We're pretty user-friendly on how they can get a hold of us for each and every one's needs. So I'm just going to go over some of the basic tax stuff. The first thing is everybody files a 1040. There used to be 3 different forms, a 1040, 1048, 1040EZ, but then Trump made it a little simplified. Everybody's just on the exact same form, which has been nice for that part, but then all these little schedules came up behind. But on the front of it, when you do your taxes, you put your name and your address, and of course, and kids, if you have any dependents, and then you fill in your income. So this is the income section. And then right there, there's what's known as, you've probably heard of the standard deduction, the itemized deduction. That's when you use either your expenses or the IRS's numbers, which is, and I did not print a list of the standards. I was going to bring the 2023 estimate, but I didn't get that printed. So, and then you deduct that, and then you have a few adjustments to income. And then at that point, you figure your taxable income. So your taxes are calculated down in here. And some of the incomes, there's various forms of incomes. There's your dividends, interest, social security, pensions, self-employment farms. There's a whole bunch of those. And Michelle's going to talk a little bit more about those later. I'll do this to see. And then once the tax is calculated, then there are some various credits that can go onto it. There is child tax credit, education credit, residential energy, adoption. Those are just a few of the most commonly used ones here. And so those come off your taxes, and then of course you can add in other various taxes. And then that determines your final tax liability. Sometimes it becomes a zero even, and you don't owe anything. And then this part here down at the bottom is, in some instances, there's some refundable credits. People may qualify for earned income credit. There's adoption credits, American Opportunity Credit. There's some various refundable ones. And Michelle's going to get more in depth on the credits here in a little bit. But I'll go first now. As I said, you do your income and then you take your standard deduction versus your itemized deduction. So the itemized deductions are calculated on a Schedule A. And they're not always usable. Medical is kind of a gray area. You hear that medical can be deducted, that's true, but yet it has to meet some limitations to get to the point of usable. And then taxes you pay has like your state withholding, state taxes paid during your current year. Real estate taxes, your personal property taxes such as your vehicles. In some states they charge you for luxury taxes in your home. Those things are what would go there. And then you have the interest you pay. And that's your mortgage interest, and usually your banks will send you a form for that each year. And then your gifts to charity. Now if you gift under $250, the companies or the nonprofit organizations are not required to report it to you, but you have to have your own record. If you donate over $250, the company will actually send you a receipt. And then I forget this one, it's casualty and death losses. That's very rarely used. That's extreme circumstances, has to be declared, something by the government, a drought, a fire, a hurricane, who knows. Just it depends. We haven't seen too many of those in our area, which is a good thing. And then you look at this itemized number or the standard. And last year the standard deduction for single $12,500, and married was $24,000. Can't remember now. There's too many numbers in every year, they change these, so then you do that, and then you calculate your taxes. But just a few other in the income forms, there is the Schedule B. And the Schedule B will total, you can list your interest incomes and your dividend incomes. And usually those are given to you by your banks, financial industries. They can be from investment accounts. Sometimes, you have an installment sale, you actually sold land and you're collecting interest yourself. And then, so you report the interest income there. And just seller finance interest. Sometimes people are a bank themselves. They loan money and pay an interest back. So then that interest is reported there. So there is actually, on this one piece of paper, there can be lots of depth to it. Order. Then after the Schedule B, there is a Schedule C, and we see this quite a bit. A Schedule C is for self-employed individuals. Lots of different types in the valley. We see a lot of truckers, contractors, beauticians, direct sales. We see numerous. It can be so many things, mechanics, whatever. But what they do is they put their business name, and sometimes it's just their name. And they put that up here on the Schedule C, and then they calculate and bring in your income. And then all of this is your expenses. They categorize advertising, supplies, it can be various. Those are common ones used for everybody. Then you can bring in some others because there are always unique expenses to each business and industry. And then you find your net income, so it's income minus expenses, and that's your net income. So the net income from self-employment, then it comes back to the front page of the return. But that actually has three in a way. It has your tax at the federal level, and the state, if you're in a state that has income tax. And then there's also what's known as your self-employment tax. Now, self-employment tax is 15% of your Schedule C income. And where the self-employment tax goes, it sounds harsh and like a punishment, but yet what it's actually doing is it's funding your retirement. It goes into your Social Security and Medicare fund. So that's one of those things that you want to manage that as time goes. You want to pay enough in that you get Medicare credits, but you don't want to overpay if you have other retirements and you don't need it. So that's one that you got to keep a close eye on as time goes. So that's your Schedule C. And then the next page here is your Schedule D. And the top part is for short term, and the bottom part is long term. But what this is it's capital gains and losses from sales of assets. You may have money in a financial institution where you sell the money there and with stocks and bonds, and you sell them and you have a gain or loss. So the short term is if you have something under a year, and your long term is if you have something for over a year. And it's better to have long term because they're taxed have a little lesser tax rate. Generally, they're 15%, but then, of course, they're not taxed on federal tax rates, they're taxed on capital gain rates. Once in a while, and Michelle will talk more about it at the end, your sale of your personal residence needs to be marked there, but that's not always taxable. So those go onto a Schedule D. And then we bring in a Schedule E. A Schedule E is for, just to make it simple, is for passive income from rental activities or royalty activities. Royalties are somebody owns money in a gas well or something, and they're getting royalties on. They don't physically do anything. They just get paid because they're the owners of this land or mineral or whatever they may have. And then the other part is rentals, which is, you rent out your house, you rent a commercial building, you can rent personal property, you can rent your car, you can rent a lot of various things. So this income is considered a passive income, and just like the Schedule C, you take the income minus your expenses and come out with a net figure. And that net figure goes into the calculations, but it's subject to federal income taxes, states if your state has a tax. And but it is not subject to self-employment taxes. It is a passive income. So that is the Schedule E. And then we see a lot of this in the valley, the Schedule Fs for the farms. They're for agriculture, plants, animals, livestock, and it's very similar to the Schedule C. It's just they give you more of that agricultural expense category than a Schedule C does. So as with the Schedule C, you bring in your crop income, sometimes there's government payments, whatever comes from it. Minus your expenses, vehicle supplies, feeding, veterinarian, just the various categorized expenses you have. And like the Schedule C, the net income is subject to federal taxes, state if your state has it again, and this is also subject to self-employment tax. So that's the Schedule F. And then we also encounter entity returns. These aren't individual people, these are businesses or individuals that have consolidated themselves into a business. So the one main one is corporations. That's a big one. It's an entity unto itself. It gets an employer number and it files its own tax return, and this entity actually pays its own tax. It's a harsh tax, 35%. It's a flat rate. Rather, these individuals can be 0 to 10. It's a ladder scale. So you gotta be, if you did get involved into a corporation, you gotta manage that money very carefully because you don't want to come up with much of a taxable income. You want to filter it into a payroll or disperse it in some other nature. But it has, of course, its income columns and its expense columns, and then the net income, and that can be subject to federal tax as well as state taxes if the state has a tax. Then the next form, that was a C corporation. This is known as an S corporation. It's the same as in C corporation, but in this case, the shareholders have elected they filed a form and they said, we want to pay the taxes individually rather than the company pay the taxes. So you fill out the form here and you put your income and your expenses among other forms, and you'll come up to a Schedule K in here, and on that Schedule K, it will disperse the money. Each shareholder, it could be 50-50, 40-60, or if there's even more, it could be 10 people, 10% each. And then so that money goes to the individual person, and that individual person will pay the taxes on their own personal tax return. So that's the biggest difference between an S corp and a C corp is who pays the taxes. But these are not subject to self-employment tax because they're corporate tax returns. And then we have what's known as a partnership. These are the people that would have Schedule C's if they were an individual, but they group up. There could be 2 partners, there could be multiple partners, just depending, and each partner invests whatever, and they have their percentage of the company. So just like the Schedule C, they have an employer number and a business name. And then they fill out the income and, of course, the categorized expenses for the partnership. And they will also fill out a K1 over here in the back. And each K1 will take its percent of the net income, and it will send it to the personal return. And on the personal return, it's subject to federal tax, state income tax, if the state has it, of course. And also these, as if the Schedule C and a Schedule F, they are also subject to that self-employment tax. So if you do become an entity or get invested in one, you've got to really think of the tax consequences and who and where you want the taxes paid. And then we do have Form 1041s. These are estate and tax returns. An estate is generally a deceased person. They passed away. They still have money flowing through, income that would normally go on the personal tax return, but now it can't anymore. So it goes on to a 1041 form, and then it's dispersed to, they're called their beneficiaries. It can be their children, their friends, whoever the person has decided to direct their money to, and whatever percent. So of course the income, their expenses on this though aren't as expensive as Schedule C. These get more into accounting fees and lawyer legal fees. And the person that is in charge of this is, when they do these, they're known as the fiduciary. And the fiduciary will actually sign a tax return to make sure each beneficiary gets their forms. And then there's also, the other part is a trust. Now a trust is a group of family, they decide to run their farm, their business or whatever through a trust rather than the individual. So the trust is like the person managing, the fiduciary is the one managing this whole thing. And then they, of course, send the net income down to the beneficiary. And they'll report it on their tax return, and they're subject to federal and state, possibly income tax. Then the final ones that we encounter are Form 990s. These are return of organizations for their exempt tax returns. They're for government entities, churches, charities, just entities that are there, you know, basically for the community. When you file to get a number for them to represent you, you do have to go through some paperwork to actually show that you are in it as a nonprofit, that you're at the benefit of the community, a church, whatever, government agency, whatever it is, but it is not taxed, that you're getting money in and the money's going to where it needs to be. Usually there's some tight budgets involved, but you do report the income here and the expenses, and they'll also ask for a bit of a balance sheet. Just, it's a lot to show you're in compliance, that you're complying with your non-taxable status, that the money is directed where it needs to go. So those are some of the deeper forms that we do. We see a lot of every one of them. I would say in the Valley, the Schedule C is probably your biggest one of these type of forms that you see. And then, so that just goes over these forms, and then I want to turn it over to Michelle, and she's going to backtrack and talk to us more about the basic income and the credits here. And I don't know if she brought papers or not.
So your income is either taxable or non-taxable. All of your income is going to be bundled together first. Your W-2s, your Social Security, a lot of people are like, oh, my Social Security is not taxable, it's pricey. It still goes on the tax return for the IRS, goes up to that office, so is our system. But we have different kinds of credits. We have refundable credits and non-refundable credits. Refundable is great, that means the money is coming back to you. Our biggest problem issue with those was the solar credits. People came into town and selling all these big solar expensive systems and telling people that they were going to get $10,000 tax credit. If you do not have a taxable income, you're not going to get the credit. It's non-refundable, which means, let's say, for example, you use your little loss. You had a bang year, you get $150,000 out of your expenses, you still have $100,000 in profit. So you will say $15,000 just to make it easy. But you put the solar system in, give you a $10,000 credit, so that's going to knock off that $15,000 that you would owe. But if you have no taxes, you don't get any money. It's not refundable. There was a lot of confusion in both offices this year. People were upset. They came into the office thinking they were going to walk out with $7,000. Education credits work the same way. So there's a refundable and non-refundable on those. And you can get both refundable and non-refundable on those. Colorado has very little income that's not taxed. Very, very little. Combat pay. If you're in a combat zone, your combat pay, Colorado is one of, I think there's like 13 states that make that not taxed, which seems like it's a wonderful thing, but there's about 17 states that make military pay completely not taxable on the state level because they appreciate it. So it's kind of a catch-22. Colorado, pretty much everything is taxable. This year, unfortunately, the way it was going, a lot of people got life insurance. If you buy life insurance, God forbid, but when I pass away, my children will get $1 million. Well, that's not taxable because I bought that policy. If my husband, God forbid, passes away, they get $100 for life, $100,000 for life, and $1 million just life insurance. It's not taxable. But his work insurance is completely taxable because that was a pre-tax deduction. They would also inherit our retirement accounts, which 401k is a pre-tax deduction, so we're going to pay tax on it later. The way that the tax system is set up is every dollar is supposed to be taxed once. And I know already everyone's thinking it's taxed a lot of times because I get a paycheck from my boss, she takes taxes out. I go to the store and spend that, and I pay taxes again. So, but the general rule as far as the income is that it will just be taxed once. So if my personal life insurance that I go buy with my write a check tomorrow, that's not going to be taxed, that's not taxed. Gifts to children, we ran into that a lot this year. You can give up to $14,000 to your children as a free gift. You don't have to pay tax. You give them $50,000, there's a paper trail. Our goal is always when you come to the office, no matter how much you make, whether you make $1 million or you make $500, is to get you to the lowest taxable income so that you pay the least amount of taxes within the law. The other thing we've had a lot of is people sell a home. If it is your main home for 2 of the last 5 years, which means you have been living it for the last 24 months out of the last 5 years, it is not taxable up to $250,000 per person. So let's say my husband and I own our house. We bought it for $200,000, we sold it for $500,000. We have that exclusion of $250,000 for just, so that's non-taxable. The other thing that people don't take into consideration when you have a house is, I bought my house first at $125,000, and I lived there for 20 years. Obviously, in 20 years, I put some work into it, and I built a garage, so you need to keep track of all those things. But that is generally, I had only one last year that was taxable that made over, and I'm happy she made money, don't get me wrong, but just know that when you make the money, and you're over that threshold, you're gonna pay taxes. I think that's the child tax credit last year. There was a lot of confusion with that. The child tax credit that was given monthly, if that was taxable, was not taxed. That is a credit. Credits are not taxed. And they gave half away throughout the year and the other half during taxes. We had calls right away in July. When are we going to start getting that again? Notice no one's got it yet. So I don't think that will be happening again. And the other thing that's changed a lot is exemptions. It used to be every unit in your house had an exemption rate, $4,500. Well, when the Trump tax law came into place, they doubled the standard deduction, so there were more exemptions. So people that were claiming their parents that lived with them, and if your parent was being legitimately take care of them, it actually gave you a tax rate when you're taxing the poor. It doesn't. And then all these stimulus payments and things, the only way to get those is to file a tax return. So some people that were claiming parents for years have had to do a little switch on that so that that parent could get the, whether it be the stimulus money or this Tabor tax money that we keep hearing about every day. I think that's.
So the brief area taxes, of course, are in depth, and we spend a lot of time taking education, but there's just so many areas, and the law changes on a regular basis, so you just got to keep up with it. That's what we do.
Selling real estate thing doesn't have anything to do with your age, it's all the same.
Yeah, there used to be a, it must have been at some point, you must have been aged out, because I keep hearing that from my Michelle clients. I've only been doing taxes since '97, and it's never ever been. Texas, I did a lot of taxes in Texas. The lady I worked for before H&R Block did taxes in Texas. She had no clients that made under her poor people made at least $250,000. Those were the poor people. And they had a thing there where if you bought real estate and sold it because you were, you were doing it for, you were doing it to expand businesses, they had a lot of credits. Even though they didn't have a state tax, they still had some different credits and stuff. Colorado has nothing. And the theory is, once I get so old that I don't have to file taxes anymore, theoretically, Social Security will tell you, everyone should file a tax return every year to protect your identity. Identity theft is the largest crime there is. I had a lady so in 2020, I didn't do her taxes. She hadn't filed taxes in 6 years. I did all of her family's taxes. But it was 2020, of course, COVID. She got her check in May. She didn't get her check in June because there was gone. Of course, Social Security was closed. July, no check. So she found out and they said that her income was too high. So several months, I guess, they tried different things. She she didn't come and meet with me until November, so we pulled a tax transfer. Anytime you're in doubt of what's happening with your social security number, you can order a transfer from the IRS. It used to be with a hit of a few buttons, not anymore. You have to ID yourself, your face has to be scanned, you have to send your ID, supposedly so that thieves cannot get your identity. But it took us, she got her last check in May. We found out in December that there was a resort in Arizona using her social security number. But she didn't get her check until April the next year. They were $28,000. So identity theft is huge. And there's no one's immune to it. She got her $28,000. So then when she had taxes that year, she had $28,000 for the prior year plus that. So that, for her social security address, we had to go and fix the prior year. And because when you get social security, a lot of people fight for it for several years. And so when you get it, it'll tell you so much was for this year, so much was for, you can go back and amend those years and add it to those years once that submit thing is done. And sometimes it works, but sometimes it doesn't. Sometimes you just do a lot of work for that. In her case, it actually helped. But it didn't, so it took us 11 months to figure it out. And Social Security would not help because they said you didn't protect your Social Security number, so they don't roll it. The IRS doesn't help anyone. So it took us a long, and I've never ever personally dealt with identity theft. That was cool. And like she said, you got a homeless paper and she had some savings. But she should have done that.
How is she supposed to protect her social security number?
File a tax return every year, because if you're filing tax return every year, then someone else can't file it for you. So she was a perfect candidate. If you're not filing a tax return, someone can earn more money, they're not going to file a tax return on that fraudulent tax. And I'm sure that this person just got another social security number. It's not going to end, but that is the easiest way to keep your identity safe, as safe as possible, I should say.
What are some of the biggest mistakes you see small businesses making that they should try to avoid before every tax year?
Bringing everything to you in a big box and going, I don't know what to do.
And the shoe boxes, used to be a thing, now it's those Rubbermaid tubs.
Well,
I think that was me.
I would say the biggest thing they make is not being consistent with their bookkeeping and keeping up with it, because as the year goes, you draw out a receipt, you're busy, it's no big deal, and then suddenly you can't remember what happened in January or February. So I would say that the inconsistency of the record keeping is hard, and I get it. I mean, I'm the same way. That's just something that we need to keep track of better.
And keeping track of the person and net sales, that's the biggest thing in our office. Someone came in and say they have this much in sales, well, they didn't tell us that included the tax, and then we're going to take the sales tax, it's not all there, that's the whole news. Whether the sales tax is in it or not, we just need to let us know. But communication is, and a lot of people want to, they call it dash and run, you drop off their stuff and run, call them when it's done. Every once in a while, we need to have a little powwow. Hey, I'm confused.
Do you offer or would you help new businesses or even existing business that just, hasn't been keeping their books right, hasn't really known how they could you help them set up Excel, QuickBooks, whatever you think would be appropriate for their business? Could you help them learn how to use that? Because some of us just don't know how to use it.
Yeah, we can help you with that.
Asking for a friend, right?
Excuse me?
Asking for a friend.
Yeah, asking for a friend. Because that's so important. It's, we have, in our business, we have a POS system. And naively, I just thought, every month we're going to report, and it's done. And I recently found out that it's not all there is to being able to write a profit loss statement, being able to apply for loans, being able to, all of those things are more than what POS system or more than what I know how to make POS system.
But you shouldn't give us, you have all the ground and all the foundations, and you just need to figure out how to put all those pieces together.
Right.
And people that don't want to invest in a POS system, nothing against, handwritten tickets, but
Yeah, what we do use is QuickBooks. I generally use that one because there may be even better ones out there, but that seems to be the most universal, that when clients bring in a flash drive or whatever, we already have the program to keep it up to date. But also we can start out new businesses. I have one in O'Hara that I go down to and meet, well, I've met with them several times when they started their business. And then now we've moved to about every 2 months now that I just kind of go check on it and answer their questions. But they're getting a lot better at it now that they've been doing it for quite a while.
I sure didn't know that y'all did that, so.
Square is another thing that people like,
Yeah,
and it has a lot of capabilities, but I'm learning that as we go.
And I'm not good at that one.
You're not good at that one, huh?
But they have an amazing tech support system.
What is that?
Square.
Square.
Square?
A lot of people use Square, that's one of the, I've learned a lot. I have one client that, he knows more than I do as far as the system, he just doesn't have taxes, so between the two of us, yeah, but it's just a system that we had used before. But it does, I was amazed at the capabilities it has. But there's an investment, because a lot of people don't want to invest the money, and we understand that.
Yeah.
Right.
Square is about $60 a month to use their system. It's an additional, I don't remember, 25 or 30 for QuickBooks to integrate the two every month. So it can add up quick. So,
Yes. And if you're paying for it and not utilizing it, then it's really.
yeah, come on out the window.
Another thing where
Go ahead.
where businesses, I think they have a tendency to struggle as they get involved in payroll, as in issuing W-2s. And it's a great idea, but they don't realize the paperwork that goes with it. You know, the quarterly, and then the IRS throws curveballs. I got one the other day, the person just started in 2021. We did the first quarter, second quarter, third quarter, we're in the third quarter. And they get a bill from the IRS that like, oh, we changed you to monthly payers instead of quarterly. I'm fine now. And I was like, that's kind of not fair just because, you know, they started out and they were compliant with everything that they got thrown at. So you certainly got to maybe, you know, look into those rules and maybe even jumpstart doing monthly if you see that that's potentially coming. So that's another thing is the IRS and the curveballs they throw in there out of the blue.
The state and the federal.
Yeah.
Do that.
I was wondering about converting a sole proprietorship to an LLC. Do you still file with the Schedule C? Or
Yes. A single member LLC is filed on the Schedule C.
Okay, cool.
Yeah. Generally, you just get a little bit more legal protection. You have an EIN number rather than a social security number. A little bit better business name, a little bit more filing with the state government. So it's more protection. They won't come after you individually. So it's a good thing, but it is filed in the same place.
Any other questions? No?
I have a question. What's the alternative minimum tax?
Oh, it's a parallel tax. We see it 3-4 times a year. But it's a parallel tax, and what it's doing is if you start taking extreme amounts of medical expenses, contributions, you're getting really high up here to eliminate your taxes. Finally, this alternative minimum tax kicks in and says, okay, you've gotten extreme over here, so now we are hitting the bottom line with this alternative tax. You're hitting this point, and you can write off $100,000 more dollars, but this is your tax, this is where you're at. So it's kind of a parallel thing to begin with, but it's a way that the IRS won't let you completely write everything off, and I see it maybe 3 times a year. I don't even know.
No one's ever.
If we get it. It's a rare one to see. I believe Marie did it, I believe she did it, because she did come in and she was like, no matter what I do, this is not changing. And I went and looked at it and I was like, oh my goodness, I was like, they did the AMT. It's unusual, but they can write off whatever else they have and they're done. That's where they're at, so.
Every client I see that shop brings that into me. And trying this last time, she's like, you're the only one that ever gets
I
that.
just have that one. He thought he could donate $100,000 that alleviate his tax problems. Well, he alleviated somebody's now with the AMT. You don't do that for someone. Government always wants
Yes.
And Colorado is a very tax-hungry state.
And of interest dealing with government entities, I would rather go with the IRS than call the state of Colorado, just to tell you how difficult Colorado can be.
This new tax that the state has put in on business people, I can't remember the letters and whatever, but it almost to me sounded like a tax on out-of-state
We're talking about the
corporations.
delivery tax.
Yeah,
DoorDash, things like that, and delivering meals. COVID came around, so people started going to all these other alternatives. So the government's like, oh, holy heck, there's all this money being made. DoorDash in the first year in the state of Colorado, they're over $2 million. So Colorado jumped on that quick overnight.
well, I spent probably 2 hours on hold waiting to talk to the secretary's office.
A lot of businesses alleviate that is they came to the store, they bought the product there, I didn't deliver.
But it's hard for me to do that as a locksmith because I had to go there and get it. Does that throw me into that?
Maybe you just delivered the service, you didn't deliver the product. And people are, my one gentleman that is, like window replacement, window tints, things like that, that's how he stayed on home for like 3 or 4 hours, he's like, this is ridiculous.
Oh, yeah, I mean, I could only last so long, and then hang up, and then
The
they said,
25 cent per delivered fee, he's like, this is insane, like, I can't get that terrorist in my life back. And my
well, my theory was, okay, if it cost me 25 cents on every ticket that I would, I'm fine. 25 cents is not gonna kill me, it's just annoying.
and it's
You know, it's like,
like,
they don't just come out and cut a big load, they just take it here, they can.
they were going off the theory when they started up, meal delivery services. And then, like you can call and go to Walmart and Safeway and stuff out there, but here we don't have really delivered to your house. You have to still go pick it up, so they don't have to do that. Some states are they actually deliver to your home. That's where the government decided there's a lot of things going on. If you notice, your Amazon is a big thing. I know everyone tries to do business locally, but you have to do business with Amazon. And if you're doing business with them, you're actually supporting the local business because they're paying state tax, they're city tax now. And it took a long time before the cities were able to get that. There was a lot of blood and sweat in that.
Amazon won't let you use links from your blog, but for that, they retaliated on that.
I know that even if I need something from Walmart, unless it's an emergency, and since I'm not a doctor or a fireman, I have no emergencies, I can wait a few minutes for anything. I'll even order from Walmart instead of driving 20 minutes to pick it up. I'd rather wait 3 days and know that my city's getting money.
My boss is the queen of couch shopping.
Of
Couch shopping. She things I didn't even know Amazon had. We needed stamps one time, and it was stressful in the middle of tax season, and I didn't pay attention to see how much time we go through a lot of postage. And so she's like, I took out one from Amazon. She can order stamps through Amazon? I had no idea. But yeah, she knows how to use Amazon all those places.
One time I ordered stamps from the USPS, and they charged me shipping for the stamps, and it took 3 months. So, yeah, from the United States Post Office, I paid shipping on them to ship me stamps,
And that's what
and it took 3 months.
I use Amazon. God forgive me, but I don't think I should ever have to pay for postage or for my luggage on my plane. That one suitcase didn't cost the plane more than gas. And my one piece of mail, if you're already doing 30,000 other pieces, I just hate to pay shipping for it, and I don't know why. I don't think I'm any better, I just don't want to pay it.
Always make a minimum with the distributor that I work with, or Amazon Prime.
Yeah, Amazon Prime, if it's,
I mean, it's a no-brainer.
if it's a little bit more with Amazon Prime, in my mind, I'm not getting shipping. And it's not a smart thing, but for some reason, I don't know why, I just, shipping kills me.
It's just that extra little
Yeah.
in your ear.
The luggage on the airplane, that's just, I mean, really? There are 260 people on this plane, one bag is going to cost me everything. So I don't know why, and shipping is big, we say that the schedule C's, I cannot believe that in the last year how much shipping has gone up with some of our ones.
Okay.
I mean, the cost of the product has gone up, which that stinks. But shipping, I had one farm, their shipping actually went up 155%.
Whoa.
That's huge.
Now, shipping deductible for business?
Absolutely.
Okay.
And that's another thing that people tend to forget. But usually when a business comes in, they bring their stuff in, you do it, and then you meet again. And when you meet that second time, all the little secrets, all the little things that you haven't found, that's when you, what about this?
Until the alternative minimum tax.
If you go to Peru, you're gonna pay energy tax.
Don't speak it, it's not.
All right, McCarroll Michelle, thank you. We appreciate it, covering some important topics, things that business owners and managers and leaders and even individuals in the community need to know. I mean, let's face it, taxes can be confusing, which is why we have master tax. But I wanted to ask what that means. You're not just a tax, you're a master.
Yeah, that's basically been having the CPA exam,
Okay.
but I have everything except that. And I haven't pursued that, just to be straight out honest. The only thing that would let me do is express an opinion in the stock market. So I can do anything but that. That's not too high in demand in the valley, so, and I don't want to. I'm not an investor, so.
We had Debbie both the coming, this is what Bible is all about. We're helping businesses, we're helping people learn and grow and move forward, so we appreciate it. You know, we are, first on this focus, we're focused on revitalizing our town here. And it's coming to the OptiMystics how we are on product as well. We came to see you this past year, we'll be seeing you again this coming year to get our taxes done too. Of course, make sure donation jar, there are door prizes too. If you haven't, everybody's eligible, even the speakers. Everything happens to door prizes as well. And we're going to bring, of course, to make them ask questions. So we have people here so we can learn to grow.